Still alive? Good afternoon, friends. Rashmi Shah here. So, from Simplicity Investing. Uh, so, I'll begin the webinar today. It's a very important topic. I'm going to talk about value and growth investments, changing dynamics. Uh, as every week, before I start, the caveats here, disclaimers that since I'm doing this webinar from US, Dallas, this webinar is only for people residing in India and Indians residents investing through Simplicity. This is not for investors in US or North America. And I'm going to talk for about 30 minutes and then I'll take your questions. You can feel free to text me the questions on the right hand side of your screen. You have a text chat thing, go to the chat and you subscribe. Also, those who have not subscribed to our channel, I would request them to subscribe our channel so you'll get automatic notifications on our other webinars on the same different kinds of topics which I'm going to conduct every week. Now, the topic I chose today, value and growth investments, the changing dynamics, because as we know, what has happened in March 2020, the world changed. COVID-19 changed the world. The coronavirus has taken everyone by surprise. Every government, every economy, every human being living on this earth. I was reading on the newspapers today that at the peak of the close down, about 2 weeks back, 3 weeks back, 4 billion people across the world were out of they were staying at home and not working. 4 billion people, 50% of world's population was under lockdown. Today, it is about 2 billion people under lockdown, of majority of which come from India. And as the world economy is trying to open. So now this has affected every industry, every business, and it has changed the dynamics. So it's very important that we talk about value and growth investments. And this COVID-19 or coronavirus is not going to go for next 3 years, no matter what the politicians tell us. Even if they find the vaccine, they'll take about 8-9 months. Then to give vaccines to everyone in the world, it'll take another 2-3 months. And then whether the vaccine is effective or not, it'll take another 12 months. So we have to live with this coronavirus for next 2 years. So every company, every economy, every businessman, every investor has to factor in that this is going to be the new way of life and how I navigate. So today's presentation, I'm going to talk how the dynamics have changed and what is growth, what was growth in last year may have become value today, and what was value last year has become growth. So everything has changed, correct? So business models have changed. So I'll give you an example. And during the month of March, nobody used to invest in stocks for companies like Clorox or tissue paper, toilet paper. In America, it was the number one hot selling items, and Procter & Gamble and Clorox. Those stocks have gone up by more than 60-70% after this coronavirus came, because those products were in hot demand. So they suddenly from defensive stock, they became the growth stock. So the dynamics have changed. So so now how we as a investor should change in India and what we should do and what we at Simplicity are doing to advise our clients also. I'll share some experiences and knowledge on that. So there's the old ways of investing out of sync today, correct? We all have to change. Now, what is growth, correct? So growth is like in life cycle, we go through different phases. Like in human beings, we are born as babies, then we go to childhood stage, and then we grow as a young man and young woman, and then grow mature, and then we get old. Same thing happens with the companies, correct? So the companies, so in the first phase, this is a startup phase, when businesses, they launch then business plans, and so this takes 4 or 5 years, and then they go in a growth phase. Then massive growth happens. So this is called the growth phase, where everything is going up at a compounding speed, and then the business matures, and this is the value phase, where and then there goes in decline phase. So these are the three phases of which every company, stock or sector goes through. Now what happens is, this period of growth may, for some companies, maybe 2 years, 5 years, 10 years, and for some companies the value period may be 20 years. So how do we identify a stock which is here, and what kind of investments you should have? You should have growth and value, or should have only value and growth, value only. So what portion we should have? So I'm going to talk about all that. I give it with real examples. Now, other thing we know, like humans we live for 85 years. Before 1960s, average US company lifespan used to be 50-60 years. You see, 50-60 years. Now the lifespan of a company is only 20 years. Now this coronavirus is going to hurt a lot of businesses, a lot of airline business, as we know, hotel industry, cruise businesses. They are going to go bankrupt. A lot of what do you call, engineering companies, big manufacturers who have a huge debt, real estate companies, many banks, they are going to go bankrupt. So there's a lot of shakeout going to happen. So where do we park our money, and how do we do that, correct? How do we identify what is value and growth? That is very critical, and it's very important to understand how we differentiate that, correct? So now, so what is a growth investing, correct? So I'll give you a real example of growth investing. Now, growth is a stage where a company goes through massive growth year after year, correct? So I'll give you the best example. The biggest growth story in India was Wipro. From 1990 to 2010, it gave a compounding return of 20, 40, 50% per year. That was a Wipro. Then Infosys in 1990, HDFC Bank. It was a growth. So they are all growth stories. Now, how do you identify growth stories, correct? So I'll share some of my personal examples in my life, how I identify growth. So now growth companies are companies which are very innovative. They come with a different set of customer service, customer experience, and they are innovators, they are disruptors, and they think way ahead of the market, 5-6 years. So Apple in 2007 came with the iPhone, which was way ahead. Nobody knew that a phone can be used this way. So they think ahead and they determine the market. Now, the other companies which copied Apple, like Samsung, their share price is not a growth story still. Apple is a growth story in those times. They never got that reward. So it becomes very important that the growth companies are a few companies. Not every company is a growth company. Not every small cap stock is a growth stock. Now, how do you identify that? Now, so in 2000, I'll give you a short example. In 2006, when my daughter graduated from high school here in US, she said, "Dad, I want to buy a laptop when I go to college." I said, "Okay, what kind of a laptop you want to buy?" I thought she would buy a Dell Microsoft laptop, or HP laptop, or Lenovo laptop. So she says, "No, I want Apple laptop." So I said, the Apple laptop costs $1,200 Macintosh, and the Dell laptop costs $600. Why you want Apple? He says, "No, I want only Apple. Otherwise, I don't want laptop." So I said, "Okay, let's go to the Apple store." So that was the first time I went to an Apple store in America with her. And that time the iPhone hadn't yet come. That time the iPods were there. And I spent with her about 2 hours in the Apple store, and they were all young kids. Most of the customers who were buying products were teenagers, and they were buying iPods and laptops and this. And it was a very nice experience. The way they were explaining, the way they are selling the products. I watched that, and I bought a $1,400 laptop for her. And I was impressed. by their service and the quality and all that there. I didn't say anything, but I felt the pinch of $1,400. I came home. Next day, I bought $10,000 worth of Apple stock. Now, Apple, before that time, before split, my cost price was $12.50. So I told my friend also, why don't you buy Apple stock also? So we both bought Apple stocks at $12.50. And within 2 months, that Apple stock was $20. And that time iPhone had not yet come. From $12.50 and it went to $20. And I'm on $10,000 investment, I made $8,000 profit. I was so happy. I said I spent $1,500 on a Apple laptop and I made 8,000. I sold that stock. And that was the biggest stupid mistake I did in my life. My friend didn't sell it. He still owns that Apple stock. And today the value of that Apple stock is $300,000. Now, I identified it very early, but I sold it also very early. Now, this is the growth stocks. You don't have to miss those kind of. Now, today, Apple has become a value stock. So, that is another experience. Now, I'll share another experience. So, growth stocks are stocks which are in the early product discovery stage, and the managements are very good. They're innovative. They're trendsetters. And the teenagers, the young population, they like those products. They're very popular among the young generation. That's all. So I'll give you another example. In 2008, I came to India. And that time, I sold a property in Pune, at my ancestor's house. And I got about 80 lakh rupees. So I wanted to invest somewhere. That time, simplicity was not there. So I said, where do I invest? So I took on MG Road, and I went on Deccan and everything, and I saw where people shop nowadays. So that time the mall culture was new, and there were three. I said, okay, this mall culture is going to do very well in India. So there were three companies that time. There was a Future Group, there was Stop Shop, and there was a Trend, West Side. So I identified all the three, and then I said, okay, I don't want to invest in Future Group because the management is not very good. So I knew that all the three companies are going to do very well. They're all going to be trendsetters, and this mall culture is not going to go. But everyone is not going to be successful. So I said, out of these three, the sector was a growth sector, but not every company was growth in the sector. So I said, let's identify the management then. So the next criteria, I used the management. In the management, I rejected the Future Group because the management was hanky-panky. Then Stop Shop and West Side remain. Stop Shop, I also rejected that because again he was a builder, Rahejas. So I said, okay, he has a conflict of interest, he may be. And then I focused on West Side, Trent. Tatas. Now Tatas are very professional. Then I checked up with few of my friends. They said it's very good company and they will grow. Now I bought 20 lakhs of Trent. At that time 800 rupee share price was there, and it was a 10 rupee stock. Now it is a 2 rupee stock, a 1 rupee stock. They got split into 10. So at 800, that means I bought it at 80 rupees. Then as it started moving up again, I invested entire 80 lakhs in that Trent, and within 7 years that 80 lakhs become 4 crores, and I exited that stock when it was 350 rupees. And after I exited just 1.5 years back, from 350 it went to 700, and today is 450. So that's how you identify a growth stock. Now why Trent was a growth stock? Because all teenagers today in India go to West Side and they buy, and it's still a growth stock. So you identify a stock based on trend, fashions, innovators, but the management also is very good and they're expanding at a compounding rate. So what are the downsides of growth stocks? Growth stocks are very expensive. Their PE, price earning multiples, are very high. So you find very expensive. They're not cheap. Secondly, they also highly volatile. So West Side that time used to go from 800 to 1000 and 1000 to 600 in a span of 2 weeks. 20% upside, 20% downside, and that's very large volatility. Even now, trend is it went to 750, 770, and it came down back to 400. So growth stocks are very volatile. Same case in US, Amazon, Google, they are highly volatile stocks. So that's another trait of growth stocks. Mm. And growth stocks, you have to really stick to it, and you don't have to trade in it. So other characteristics of growth stocks are their innovative global uh, approach they have, the best practices of the world they use, their market leader, and their brand and quality reliability is there. So this is the factors you have to look when you identify those stocks. Now, again, what is growth and what is value may differ from person to person. So there's a lot of gray areas, but normally the growth stocks are stocks which are industry leaders, they're innovative, and they grow in a compounding rate. Now, what are value stocks? So value stocks is a company which has matured, which has grown up and which has matured, and the business organic growth is not there. They grow inorganically by buying other companies. So you find the companies like, in the old L&T is a mature. Now Hindustan Lever was a value stock for 10 years, from 1995 to 2012 or 13. It remained between 250 rupees. It never moved. Then suddenly from 250 it became to 2000 in a span of 5 years, correct? Every year it doubled. Now after it changed its business strategy. So value investing, it takes a very long time. It's a mature company, and suddenly after the management redecided the whole strategy, it became a growth stock. Otherwise it was a value stock for 20 years. So currently ITC is a value stock. ITC is a value stock. It has a lot of assets. Now a lot of all these PSU banks are value stocks. Now every stock, so they have a good business, a stable business, but they don't see compounding growth, and they are not innovators. They can't innovate too much. Now, what are the downside of value stocks? The value stocks, the downside is sometimes every value stock, though they give you very high good dividend yield, they may not grow, and it can hit you very badly. Take for example Tata Power. Tata Power was one time a very good growth stock. Today it is a value stock. It's come down from 300 to 30 rupees. You take National Aluminium. There are so many other stocks in the old economy which were very value play. The book value, BHAL, the BHAL on a balance sheet has a cash balance of 7,000 crores, and market value of BHAL is 7,000 crores. BHAL was a 400 rupee stock. It has come down to 30. Just 30. Most of this PSU bank, State Bank is the best example of a value stock. Now, the disadvantage of value stock is you have to hold them for a very, very long time to get some good return. Growth stocks are highly volatile, but in the short term they can give you very good return. Medium term they can get very return. Now, in your portfolio, you should have both of them, a mix of both of them. Now, how do you identify good value stocks? Not every value stock is a good for investment. The good value stocks are stocks with, again, with a good management. They should not have any debts. They should be, the less than debts they have, the better they are. And they are capable of buying other companies out, and that's how they can grow. And they are mature product, and the management is very good. So only those growth stocks should be bought, not everything else. Now, like I give you another example. Now, every growth stocks or growth sector or value sector, sometimes it may not be a good idea to buy a stock. It may be a good idea to buy a fund. For example, let's take the pharma industry today. It's very difficult to identify which pharma stock you should buy. But pharma as a sector has become a growth sector now because of the coronavirus, correct? So instead of handpicking a stock, you buy an entire sector, buy a sectorial fund. You are taking more risk when you are buying a stock in a pharma sector than you are buying a basket of stocks through a mutual fund. So that may be a strategy. But if you want to have an exposure to Hindustan Lever, you may buy Hindustan Lever stock and instead of buying a sector, correct? So there is a different strategy to be applied differently. Now, it's very important to understand what you want and what kind of portfolio you want to build. But you need to understand the characteristics of this. So how does one know whether this is a growth stock or value stock? So I'm going to give you a few examples here. Where, now, let's take auto sector today, correct? Auto sector, before this coronavirus, before I give this Amazon, Google examples, let me talk about the auto sector in India today. Before this coronavirus happened, there are four-wheelers and two-wheelers in India. So average age of a person buying a four-wheeler is 35. Average age of buying a person two-wheeler the first time in his life is 22. Average age of India is 27. So what stock you should buy based on these statistics? You should buy four-wheeler stocks, not two-wheeler stocks, because the average age of India is 27 and the average first-time car buyer is 34. So we are going to see more demand of four-wheelers in the future. But the coronavirus changed the dynamic. Why? Because social distancing, everyone has not going to use public transport and everyone needs a vehicle. People are going to use more vehicle. So then they need to buy, everyone can't afford to buy a four-wheeler. So there is going to be a spike in the demand for two-wheelers. So two-wheelers become a growth stock, growth sector, than a four-wheeler. That's the case of India. But you take case of America. I was watching on television, someone asked a question today to a doctor that if I have to travel 1,000 miles, is it safer to fly or to drive? So the doctor said it's safer to drive instead of flying, because when you are driving you are driving in your own car and you control your own destiny by following the hygienic and social distancing pattern. When you're going by an airplane or you're flying, you don't control the environment there. So it's safer to drive. So in America, people are going to buy more cars and they are going to drive more, and instead of buying a flying ticket, because they can afford cars here. So in America, after this coronavirus and economy opens up, cars industry will do very well, not two-wheelers. But in India, two-wheelers will do well. So again, it depends on case-to-case basis, what is growth and what is value, correct? Now, today, Amazon became suddenly an extremely popular growth stock after coronavirus came. It has crossed all-time high, correct? It's even pre-corona price. It has broken and it has gone to 2,400. Before coronavirus happened, it was $2,100. So why? Because of the change in the dynamics of the economy. Same case with Google. Same case with Hindustan Lever. Everyone see why these have become growth stocks, because of social distancing and eating more food at home. So before, everyone in India used to eat food at restaurants, means 20, 30, 40% of the time we used to eat food outside. Now we are going to eat more and more at home. So a restaurant consumes more unbranded products. When you eat at home, you buy more branded products. So suddenly you will see a spike of growth in Hindustan Lever. You see a spike in Amazon, Google. When you're working from home, you're going to send more emails. Oh, by the way, do you know that the number of emails on internet sent during the coronavirus jumped up by 120%? The internet usage has gone up by 100% in last 2 months. So this technology company suddenly became a growth stocks. So that, and you can see the performance in the share price in last. So what I'm trying to say is this COVID-19 has changed the entire dynamic, and you have to change your portfolios and work it that way. Now I'll give you another example, growth versus value sectors in India, correct? Let me show you. This has come now. In India, the financials, healthcare, communication services, they are all growth sectors as of today. Communication services means Airtel, Jio, Vodafone. Now, of course, Vodafone has another problem because structurally they took too much debt. But if they didn't have debt, Vodafone would have been extremely good growth story, correct? Now, if they're able to manage their loans and they're able to settle the dues of the government, the stock is very good. Now, real estate, consumer staples, materials, oil and gas, they have become value stocks now. They have become value stocks. So whole dynamics has changed. Now, I'll share another example with you. growth and value sectors in US. Now some information technology, healthcare, communication services, consumer discretionary, they're all growth sectors. Utilities, power companies, consumer staples, financials, industrials. Financials in India are growth. Financials in US are value. Why? Because in India still is a unbanked country. Only 40% are going through banking transactions. Now with COVID-19, things are going to even change more, correct? Things are going to change more. So you have to see how the dynamics changing, correct? Now in certain sectors, instead of picking up stocks, you need to play those sectors, growth sectors, through mutual funds, because then when you're picking up a stock, you're taking even higher risk on a sector and a stock. Both are going to do growth wise. But if you pick a sector, you reduce the company risk. So you have to manage that, which is good for you, and accordingly play the strategy, correct? Now, yeah, how much growth and value you should have in the portfolio? That's a very good question. We should have both in the portfolio. Now, how do you know this particular company is today Infosys a growth or value stock? Now, today, if you see, Infosys was a growth story from 1991 to 2000, when it was compoundingly growing every year by 40-50%. Now it's growing at 10 or 20%, correct? So HDFC Bank, you see, HDFC Bank was 17 rupees 50 paisa in the year 2000. 17 rupees 50 paisa in year 2000, and from there it went to what? It went to 2000. No, not 2000. Sorry, HDFC Bank went to yes, 1275, and today it's 888. So see the multiplier. On 17, suppose somebody bought at 1750, I had bought them, but unfortunately I sold those HDFC Bank shares in 2006, because when I saw things 2006 and 7, I started seeing bad things happening in America. I sold all my stocks in India. I sold at HDFC Bank at 600 rupees in India at that time. Now see the growth story here. It was 17 rupees to 600 rupees, but from there it went to 1200 rupees, and now 1200 rupees here, and now it's corrected, correct? So now it's a value play. It's a value play today. But still, it can become a growth story, because we don't require 2000 banks in India. So the consolidation is going to happen in the top 5 banks: HDFC, ICICI, Axis Bank, and the growth story is still there intact in HDFC if it plays correctly, correct? So we can see that in next few days, next few quarters or years. So it depends on how you look at it, correct? Now you recognize this stocks, Apple and Microsoft. They have suddenly become the growth story all over the world. You can't today. Lockdown wouldn't have been possible if these stocks didn't exist. They changed the life of the world, these two companies, in last 20-25 years. Now, of this, Microsoft is an amazing story. This company went from startup to a growth to value, and after value, most of the companies decline. This company went from startup to growth to value, and again it has gone to a growth. I'll show you by graphically here. So if you see, Microsoft grew drastically in this first phase before 2000. So from $1 it went to $30 here, and then for next 15 years it remained below $30, and that was a value play. I remember this, and once it broke $30 in 2015, I think in 2015 it broke. I bought that share at $30. I sold it at 50. I thought it was too. Then it went straightway to $200. See that? See, this is the growth. And when this kind of growth happens, it's not a good idea to trade in the stock. And I made those mistakes, and I had to buy the Microsoft again at 160. So at times when you trade a stock, there is a risk that you may sell it very early because you see a very good profit. But if you're in a mutual fund, it doesn't happen that. They hold it for you. So again, when you see a growth sector, at times it may be better off to going through a mutual fund or ETF rather than playing a stock. But It's amazing, correct? Human behaviors are amazing when you see. Now you'll ask me, which is the better sector to play, value or growth? So of last 100 years, first 80 years, the value did very well. Last 20 years, 25 years, growth has done well. Your growth had happened, done very well. Why? Because the technology started changing and disrupting everything. So when disruption happens, growth stocks do very well. When there is no disruption, life is normal, no innovation. At that time, value does very well. So in this time, Coca-Cola did very well. Coke did very well. In India, Tisco, Tata Motors, those kind of companies did very well. ACC, ACC was a darling during Harshad Mehta time. L&T, Tata Power, BCS, all those stocks which were value in this time, they have gone. Now growth has come back. Correct? So it because of the disruption of the innovation and technology which has happened. Now, currently with COVID-19, growth stocks are going to drive the world economy everywhere. There is going to be a massive change. Now, the other thing, you should not get confused with small cap stock as a growth stock. Every small cap is not a growth stock. I'll give you an example. Out of 1,000 small cap, there'll be one growth Infosys. Or out of 10,000 companies, you'll find one Microsoft. So small cap should not be understood as a growth stock. Every small cap is not going to grow. Only the companies which are innovative, they are disruptive, like Uber, disruptive, correct? Paytm, disruptive. Now Paytm has lost the track because Walmart, Google Pay, everyone has come to India. So Paytm is losing its market share. But you need to understand that you pick up the right stock at the right time, or you pick up the right sector and play the sector. Now in your portfolio, you should have both. Well, you should have value plus growth, and you should have a mix of this. And this is the way you do it, depending on the economic cycle. Correct? The way the in today's economic cycle, I would play after COVID-19 50-50. I would have 50% in growth and 50% in value. And that's how I balance my portfolio. Today is not the time to go extremely aggressive. I would avoid cyclicals. I would focus on more defensive, healthcare, more FMCG, more technology, more US equity, and bank and play defensive. And aggressiveness, I'll pay only through banking stocks. And that's how you play a strategy. That's a strategy you play, correct? Like a football match, every purpose of every game is to win the match. But that doesn't mean you put all 11 players in the forward. You need to have a goalkeeper. You need to have a defense team. So you need to have, just now, your team is getting attacked by coronavirus. So you need to have more defensive players and less aggressive players to save your goalposts. So this is the time not to go aggressive. And now let's compare every country, whether it's a country, United States is a growth stock. So if US is a stock, India is a stock, and Europe is a stock, what are they, growth or what do you call value stock? So here's I'll define it: large cap, small cap, medium cap, and small cap, value, growth, and blend. Correct? So if you see United States, they fit in here. India is a small cap in a value play, in a blend play. So why India is here? So if you take Apple plus Microsoft, their market cap is equal to $2.5 trillion. India's market cap is $2.5 trillion. So if compared to the world stock market, India is a small cap stock, a very small cap, or two stocks of a, so that's why it's called a small cap. And there is a little bit growth because India's population is here. Why it's not total value, why it's not extremely growth also, because India is still not a leader in innovation. India is a very good country in adapting, and they have a very good consumer base. A lot of young people, large population. So India is here. It has a potential to go up here, but it will take a long time unless we lead the world economy in innovation and our mindset changes. Today we don't know whether India is a 100% capitalist country or it's a social country, correct? So we get mixed signal from the government. So in COVID-19 in America, they didn't say that you can't fire people, but the Indian government came up with a law that you can hire but you can't fire. You can't cut wages. So if I don't have money, how can I pay wages, correct? So they are sending mixed signals. So that's why India is today here. If India wants to become the growth story of the world, the business dynamics and the clear signal has to come from the government. Ease of doing business should be changed. So it will take some time. But I'm not a pessimistic person. I'm an optimistic person. I'm sure things will change. So this is the way you play. Now, in your portfolio, today in India, 99% people are invested in Indian stocks. So they are all in small cap. Technically speaking, you should have minimum 50% large cap, 50% value, correct? Now, if you have all small cap India stock, you're at risk. So you need to diversify, invest. Every Indian need to have a certain portion in US equity and high value side. In India, people take too much risk by investing in small and mid cap. They should invest more in large cap and more in global stocks. That's the other lesson which I learned this thing. And as I said, only 1 in 1,000 small cap becomes a large cap or growth stock. And you have to see out your portfolio, how much risk you want to take. You don't want to take that kind of risk in this market. Now I'll give you a case study. This is my last 2-3 slides, and then I have to take question answers. Now, this is a real portfolio. I'm a generic portfolio of a 60-year-old person living in US. He's of Indian origin and he's 60 years old. And this is a retirement portfolio. The entire portfolio is for retirement corpus. All his financial assets are in this. There is no other financial assets other than this portfolio. So he depends on this portfolio, and he works, the portfolio family wants that portfolio to give retirement income for next 30 years because he's 60 years old. He's assuming up to 90 years live, and the portfolio size is medium. It's between 3 to 5 crores. So how this portfolio has been invested, how it's been broken up, I'll share that with you. And this data I have taken as of today. So the reason I'm doing it, when you invest, people invest in randomly. There has to be a strategy. See how the strategy has been done. And this is actual analysis of the US portfolio as of 15th May. And I have not made up this data. I have downloaded this data actually from the software. So the gentleman has 70% stock in US stocks because he lives in US. So the fundamental rule of investing is that if you're going to retire in US, any country, wherever you're retiring, 70 to 80% money should be in that country. Only 20% or 30% should be outside that country. So if you're living in India, it's fine if you have 70% money in India. Why? 30% should be outside India. If you're living in US, you have to keep 70% in US, 30% outside in US, in Japan, India, Switzerland, wherever you want. So this is the 30% foreign stock he has. So rightly structured. Then see the blend he has, correct? So this is the analysis done by independent agency. This is not done by him. So the Dow Jones, so this is small cap, mid cap, large cap. And this is the valuation. Value stock, growth stock. So this is Dow Jones. The Dow Jones Sensex stocks, the index stocks, they fall in this category. His portfolio also falls in this category. So it represents. So this portfolio is going to move the way the Dow moves. So it's a safe portfolio, correct? Now, if you look at the other way, this is the actual evaluation of his portfolio. So in Dow has 30 stocks. Those 30 stocks, 27% are growth and large cap, 26 are mixed, correct? They are value and large cap. 26 are pure value. This is growth and value, correct? And this category, which is small cap and value, this is less representation. Here he has very less representation. And you see his 79% is stocks in 80%, 90% stock of portfolio is in large cap. Very good, safe player. Now what he has done, he's ignored these sectors which are value, like utilities, real estate, energy, materials. So this company industries require a lot of loans, a lot of debts. So he said this is not going to do well, and they are going to be impacted by coronavirus. Airline stocks, manufacturing companies, he has avoided them, zero. And this is a index. So index has this much component in it, but he's put zero in that, and he has overweight in communication services. So communication services is like Apple, Google, Microsoft, consumer discretionary, industrials, financial and information tech. So he's gone overweight here and he's ignored this sector. And that's how he has built up a strategy to beat the Dow Jones Index. And trust me, he's outperforming the Dow Jones Index. And this is the way you build a portfolio. There is a strategy behind it. So you need to look at your portfolio very holistically and see the big picture. If you do that, so you need to understand when to buy a stock and where to buy a mutual fund and what sector I have to buy and what allocation I have to give. And like in your food, you don't eat randomly Mexican, American, Indian, North Indian, South Indian, everything mixed. You eat a cuisine, correct? You eat either South Indian or you eat so everything is well balanced, connected. So in your portfolio also, all your stocks, they have some relationship. If one goes up, other goes down. That what kind of relationship the portfolio has within the stocks. That also you need to understand. Now, starting this week, I've started a knowledge puzzle just for this, nothing to do with stock market, nothing to do with. So when I do this kind of research, many times I ask my question, which was the most important innovation done? So I said, why don't I share with my audience this week? So when I was doing this presentation, I asked certain questions to myself, which was the most important innovation done by the human mankind. And I was surprised by the answer, which had impact on the world economy and the human behavior. So this is a debatable. You may think differently. This is not my personal answer. I took it from a reputed source, and I'm disclosing that source also here. So 11 innovations that changed the world history, and you can go on this website and it will tell you that worldhistory.com, and this is the website. It will tell you the number one. You'll be surprised. The printing press was the number one innovation which affected the human mankind. Why? Because this allowed us to print books and education. That's why printing press is considered to be the most impactful innovations the humans did. The second was compass, because we could travel. That's why after this compass was discovered, America and North America, South America was discovered by Columbus. Then the paper currency by the Chinese in 19th century. Then the steel in 1850, the new manufacturing process still was there 4,000 years ago, metals. But the new 1850 onwards, it became the electrical bulb in 1859. The reason I'm showing this, coronavirus is going to lead to a lot of new innovations. And that's where we need to focus. Our portfolio needs to have aligned, because the world is going to change. So which was, sorry, one second, I went too fast. So which was the 6, 7, and 8, correct? 6, 7. So the sixth one was domestication of the horse, correct? The horses, 5,500 years here, and horses were very popular till 100 years back when car was discovered. Automobile car came in 1900. Till that time, horse was the main mode of transportation worldwide. Then the transistors, there is a chip, 1947. Today, everything has a chip, correct? So this was discovered in 1947. Magnifying glass. Many times I think 500 years back, if you live beyond the age of 40, we all need reading glasses, 45. How the people used to read then? There was no glasses. So in the year 1300, magnifying glass came, correct? Can you imagine Aurangzeb was ruling the country till the age of 85? How you could read the books on this. Then I saw some historical movies where they used to write in a very big alphabets, because there were no reading glasses that time. Telegraph came in 1850. Antibiotics that changed the lifespan, correct? Before the average age of humans was less than 40 years before 1943. People started living to 90 years because of this antibiotics, correct? After that, this was another discovery which changed. And the next discovery was, okay, one sec. I'm messing up here. Uh, 11 is the steam engine, and the final was internet. We yet to know. Internet is the 12th one, which has come in last 20 years, and we are going to see it's going to shape the world. We still don't know the full effect of internet. In the coming 2 decades, you will see Amazon, Google wouldn't have born today if internet was not there. Correct? Uber wouldn't have been possible. See the way Uber is doing, correct? Uber is considered to be a very big innovation. Mobile phones wouldn't be there without internet. WhatsApp. I couldn't be doing this webinar today without internet. Can you imagine that? Even 25 years back, me sitting in Dallas and talking to all of you in India, and that too without any complications. So I'll stop here and I'll just share the next week's topic. What I'm going to do is, like, every time I disclose what I'm going to talk next week I'm going to talk on volatility in financial markets, good or bad. This is a very interesting topic. At times, I'll give you a classic example. Volatility is good. So I'll give you an example of the pharma fund. We make every client of ours invest in pharma fund since 2014. Now, what happened is pharma fund did very bad in the year 2016 and 17 and 18 because of FDA regulations clamped down by US government on Indian companies. Now, I had great difficulty but I convinced all my clients. I have more than 100 doctors as my clients, and many of the people were pessimistic on pharma sector. I said, no, we need to keep investing in pharma. Without pharma, healthcare, this is the, if don't buy health insurance, I'm fine, but keep investing in pharma stock. And that paid off. In this year, the pharma fund has given 30% return. It's one of the best performing fund in a corpus. Now, I have also noticed in some of my clients, we gave them an allocation of 15%, but because the pharma fund performed so well and other sectors didn't well, the pharma weightage has gone to 30% in the portfolio. So that is the key. So volatility is the key, correct? So pharma fund came down from 155 to 115, and from 115 it bounced back to 180. So what happens when you're investing through SIPs? If the more the volatile the fund is, the better it's for investors. So sometimes stable funds are not good, volatile funds are very good. So I'm going to give this kind of real examples next week, why volatility is your friend and not an enemy. Thank you. Now I'll take your questions. Now what we are doing is we are clubbing, due to shortage of time, clubbing common questions into one. And if I miss some of the questions, I'll answer to you individually. The first question is, share your opinion about Avenue Supermarket stock and IRTC stock, value and growth point of view. Okay, so both these stocks, Avenue Supermart and IRTC, are in the growth sector. So both are in growth sector. Now there is a tremendous competition in the retail sector. Now if you take today in India, 18% of India's GDP is spent on retail. Retail means food consumption, 18%. But how many of that stocks are in Sensex? Like America, Walmart is in Dow Jones, correct? Walmart is a grocery store. We don't have a single grocery store in our Sensex today. Now we will get eventually. Now Reliance is also in grocery business. It's there. Now there is going to be a major competition there. Now how this plays out. So what I would do is, instead of buying this retail stock, of course Avenue Supermart today is a growth stock. It is a growth stock. IRTC is also a growth stock because it's online booking and private government partnership. But I don't know long-term IRTC is a good stock or not. Like, again, there is a government there, correct? Anyway, it's government. If I'm making money, I'll sell it and get out of it. I don't trust the government. Not because government people are bad, because governments don't take decisions in time. I'll give you a classic example of Air India. They should have sold Air India 5 years back. 3 years back, they were ready to sell. Mm, but they didn't get good off. They got some offers, they rejected them. Last year they were ready to give Air India free. Now this year they are giving Air India with a dowry also. Still nobody wants to buy. Today government wants to give Air India to someone, plus they'll have to give them 10,000 crores. But still no one will take Air India. So government and IRTC, again government is there. So if it I would avoid it. If I'm making money, I would get out of it, and I'll find a better sector where can I predict the government behavior. Uh, IDFC First Bank growth stock or a value stock? Uh, yeah, it's a very I do have in personal investments in IDFC Bank. It has not done well. It has come down from 60, 70 to 20 rupees today. Um, I would play banking sector as a whole. I would invest in a sectorial fund rather than playing the stock market, because uh, again I'm saying it's a very difficult sector to handpick a stock there. And IDFC has a lot of legacy of still old term loans, and they are still NPAs, correct? They are dragging it. Technology wise, it's a good bank, but they are not the first to innovate the technology, correct? HDFC Bank and ICICI Bank were first. See, I'll give you another example. Apple was the first to come with iPhones, then Samsung came. But you know that 90% of mobile smartphone profits in the world, Apple has only 15% market share, but 90% share in the profits, 90% share in the market cap. Now, IDFC is no longer that way trend setting like what HDFC was in 1995 or ICICI was there. So it's a with Tesla be a growth stock or value stock? Tesla is a growth stock because the market cap of Tesla is more than General Motors, Ford, plus Honda all put together. So if you want to compare Tesla with Tata Motors, Tata Motors have $24 billion revenue. Tesla has $12 billion revenue. But Tata Motors market cap is $2 billion. Tesla's market cap is $45 billion. So Tesla is a growth stock because it has innovated the way how car has to be. It's a different league altogether. What kind of services does Simplicity offer? Wow. And how can it help us in identifying growth and value stocks? Okay. Yeah, you can contact my team. What we do is Simplicity does not is not a stock taper, or we don't believe in short-term trading or making money every day. We build portfolios for clients, and we try to, if you try to play the market, you'll always miss the big picture. And we try to see what the market is and try to build a long-term portfolio for clients. Of course, we do see sectors and stocks, and we do invest in globally. We are not only India focused, we are global focused. So we invest in US markets, we invest in Japanese market, we invest in Indian market, and yeah. Now you can contact us, go to our website, and feel free to contact any of my team members, and they'll guide you. Which factor plays major role in growth stock or value stock? Top management or macroeconomics? Oh wow, very nice question. Both plays more important. Management is extremely important. So if the sector is growth, but the management does wrong strategic decision making, then you are screwed, correct? So management is very important. Management plays a very critical role. Both are very important. Should agricultural process company be a growth stock given the new laws? No, it's not going to. Okay, so it's a agricultural value is a value stock which will give you a decent return if the company is good, but it's not going to be a growth stock, where growth stock is stock which catches the imagination of the entire population. So Apple, internet, mobile phones, the entire population's imagination get caught up. That's a growth stock. When only it catches the imagination of a small segment of population, it's not a growth stock. So agricultural economy of India is only 40%, and that too it's very way over diversified. So it's a value play. Investing in real estate would be a good idea, or we should wait and let the market price get correct. Real estate today, it's value. It's not a good time to invest in real estate. Real estate is okay. So I'll share some data. I was doing some research. The total market cap of the world is $80 trillion. The total value of real estate in the entire world is $250 trillion, of which residential real estate is $150 trillion. Commercial is the rest. So in this coronavirus, people realized that if I want my money, I can't sell real estate, but I can stock financial assets. So financial assets, even in today's market, are under-owned. Real estate is over-owned worldwide. In New York, the real estate rentals have fallen by 75% this month. There is a commercial real estate excess supply because of this coronavirus in the short term and medium term. Residential real estate is over-owned in India. So the upper class, the rich class in India, everybody has on an average more than 7 to 8 real estate properties. I know my clients. Every client has a lot of real estate and they're waiting for a right exit opportunity. I would buy real estate only if I have to stay. I wouldn't invest. This coronavirus also will teach all NRIs that if they have invested in real estate and they're not able to travel because their visas got cancelled, what is the real estate in India of any use? So all the NRIs are going to come to sell that real estate. So if a US citizen has a real estate in India and he can't travel to India, what is the point in having that asset? So would you buy an asset in South Africa and stay in India, a real estate? No. Shouldn't your money be closer to you? So there is going to be a lot of selling in real estate. Next question is Lupin, Dr. Reddy a value or growth? Okay, the sector is a growth play. The stock, I don't know. It will again depend on the management and the drug approvals they get. The sector as a whole is a growth play for next 3 years. For a retired person with cash FD, should invest in SIP or lump sum in a corona world? Okay, so it depends on the person's situation. Now, if a person is already invested in the market, then he should stay invested in the market. This is not a good time to exit the market and convert into FD. Now, if person is never invested in the market and he has everything in the FD, then this is a good time to start building the portfolio. So it will depend on case-to-case scenario. Now, at any point of time, every person should have next year's 1 year's household expenses in FD. Every person, no matter who you are. If you have, so I'm 60 years old. I don't believe in FDs, but I keep my next 6 months expenses as liquid cash in my portfolio. Now, if I keep money in FD, I don't sleep in the night. I don't remember when I had kept money. So because I'm in this business, I do that way. Maybe I'm a biased guy, but everyone should have a minimum 1 year's household expenses, a bank FD, or maximum 2 years, not more than that. The rest should be deployed in the market and build a portfolio and structure. Now, how you build a portfolio, how you invest, it will depend on case-to-case basis. This is not the time to exit the market. The next question is, I hope I've answered this question. And if you still feel I have not answered it properly, we can meet it and we can take it further there, one-to-one. How are mutual funds selected at Simplicity are planned? Balance or growth and value? Okay, very good question again. So at Simplicity, I don't believe in generic funds. I don't believe in large cap, multi-cap, balanced funds, small cap. Small cap, we hardly give any investments in small cap. And we had little exposure in large cap funds. We are also exiting from all generic funds, and we invest specifically in sector funds. The reason we invest in sector funds is I would like to have a growth and defensive sectors. So I want to avoid sectors where I don't know how the coronavirus is going to play for next 2 years. Whether this epidemic is going to kill, you get all kinds of answers. People say that 5 crore people will die in next 3 years. So if that's going to happen, I need to be very sector specific. So that's why then in that case, I have to be overweight pharma. I have to overweight defensive stock, FMCG stocks. So, and the best way to play that is be sector specific. Don't invest in so you have a growth is where is US. I'll invest in Microsoft, Google, Apple. So that is a growth sector. Now no matter what happens in the world economy, that sector is going to grow. Everywhere digitalization is going to grow more. Even the government, to keep tab of every person on the world or in the country and on their neighborhood, is going to use technology. So they are going to use technology by whom? All these 5 big technology companies in the world. So I'm going to invest in those sector funds of US equity. Then I'm going to invest in pharma funds, because worst thing can happen. Then I'm going to invest in good managements, which are multinational companies, and I'm going to play technology stocks, and I'll build the portfolio that I would avoid small cap and mid cap. Now, yeah, I hope I've answered this question. Thank you for participating in it, and do share your feedback to us if you like today's event, and I'll see you next week at the same time. Thank you. Have a nice day. Thank you very much. Bye bye.